66% of merchandise in 2018 was purchased from Nike. So if there was a change in that relationship, that could substantially hurt the business, because of course Foot Locker is dependent on Nike and Adidas and these other suppliers, and there's only 5 suppliers that make up 90%, so they're controlled by a small number of suppliers. That is what I said about Foot Locker back in 2019 when I was first analyzing the company as an investment. At the time, I had absolutely no idea that Nike would be cutting back its relationship with Foot Locker only a couple of years later, but it was also extremely obvious that Foot Locker was exposed to this kind of move. In today's video, I simply want to revisit Foot Locker as a potential investment. I'm going to explain the big change to the Nike Foot Locker business relationship, and most importantly, I'm going to show you how I avoided a 70% decline in Foot Locker's stock price and how you can do it too. If you get some value out of today's video, all I ask in return is that you hit that subscribe button. It's been a dream of mine to hit 100,000 subscribers for so long, and we're getting pretty close to it, and you guys can help with just a click of a button. In fact, about 45% of you are not subscribed, so if all of you went and hit that subscribe button, then we could reach 100,000 in no time. Foot Locker is a global retailer of athletic footwear and, to a lesser extent, apparel, and they currently have over 2,800 global stores. And Foot Locker's business is relatively easy to understand. They wholesale purchase footwear from big brands like Nike and Adidas and sell them to consumers through their store network. And they actually only have business relationships with a handful of really major athletic brands. In fact, in 2021, 70% of revenue was generated from the sale of Nike products alone, and over 90% of their sales come from their top 5 suppliers. This will be important later because their overexposure to Nike in particular is the key reason this week why the stock fell over 30% in a single day. But before we get to analyzing that event in particular, let's talk about some of the key areas that are important to assess when we're looking at every single business. Let's start with the management team. Of course, every company we want to invest in has to be run by a skillful and trustworthy management team, because we are owners, but we're not managers, right? We don't get to go in and decide what products they launch and how they allocate capital within the business. We are trusting the executive team to make good decisions on that front. So we need to make sure that we are assessing them by looking at whether they're trustworthy and transparent to the shareholders, as well as how good they are at allocating capital and keeping the business in strong financial health. And on the management front, Foot Locker is a very, very well-run business. According to Macro Trends, the ROIC for Foot Locker has been well above 10% in most years and is often much higher than 10%, 15, 20%. And what the ROIC shows us is how effectively the management team is allocating capital within the business. So for the profits that come in, and also through the use of debt sometimes, how are they putting that money to work and what return are they getting on those internal investments? And they've also been able to be very, very efficient at investing within the business while using relatively low levels of debt, which is something that we look for so that we are confident that the business is going to be okay in short-term, weak economic periods. Once we've looked at the people running the business, we then need to pivot and have a look and see if we can identify a distinct competitive advantage, something that Warren Buffett calls an economic moat or an economic fortress, something protecting the business and ensuring that it thrives over the long term. Foot Locker strives to achieve a superior customer experience when you go into one of their physical stores, and they do this through a combination of things including store layout, competitive pricing, customer assistance, and having a range of products that customers desire, which in this case is primarily Nike footwear. And on the back end, they're able to build these strong relationships with big brands like Nike because of their massive store network, over 2,800 stores around the world, and these stores are located in areas where there is significant foot traffic, no pun intended, which allows these big brands like Nike to sell large quantities of shoes at wholesale to companies like Foot Locker. But the relationship between Nike and Foot Locker is certainly not equal. Foot Locker might have an amazing store layout, an amazing customer service, but ultimately the reason customers are going to the store is primarily for Nike footwear, and if they didn't supply Nike shoes at their stores, then customers would very likely shop somewhere else. Of course, Nike does rely somewhat on Foot Locker for that final leg of the sale in order to get customers to purchase the shoes off the shelf, but it's not an exclusive relationship. Nike sells their products through other retailers as well, including their own physical store network and through their e-commerce site. When you're trying to figure out if a business has a wide economic moat, a good question to ask is, what is compelling customers to keep coming back? In this case, what's compelling customers to come back to Foot Locker is the range of footwear, which is almost entirely Nike products, and that actually leaves them extremely exposed to a change in that business relationship. And that's exactly what happened this week, causing the stock to collapse over 30% in a single day. This occurred when Foot Locker reported their Q4 2021 and 2021 annual results. Revenue was up 18.7% year over year on the back of comparable store sales growth of 15.4%. And overall, they did have a very good quarter and a very good 2021 in its entirety, but they also made an announcement about a big change to their business relationship with Nike. As mentioned previously, Nike has historically been the biggest driver of revenue by far for Foot Locker's business. In fact, Nike shoes represented 75% of sales in 2020 and 70% in 2021, but this is expected to drop to 55% of total sales starting in Q4 2022. And Foot Locker said that this reflects the accelerated strategic shift to direct-to-consumer by one of the company's vendors. So what this means is Nike is essentially going to focus more on selling directly to consumers through their website, rather than using retailers like Foot Locker as a middleman or for that last stage where they get access to the customer. And this makes perfect business sense for Nike because as more consumers buy things online, that means there will be less traffic to Foot Locker stores and more traffic through e-commerce sites online, so they can capture a larger part of that audience directly and probably do it at significantly higher margins because they can sell products at retail prices rather than at wholesale prices, which is what they were doing with their relationship with Foot Locker. And even with this change beginning in Q4 2022, the end of this year, Foot Locker is projecting -8% to -10% comparable store sales for the full year 2022. And this means that the full effect of this change in the relationship actually won't be seen until 2023. And if this year, with one quarter of that change, they're already projecting -10 or -8 to -10% drop in the sales at their stores, this represents a huge shift in their business. So how could you have avoided the 70% decline in the stock that's happened over the past couple of years, I think now? How could you have avoided that? I've heard a number of people talk about margin of safety when it comes to Foot Locker, but I really don't think margin of safety applies in this case, because the truth is if a business doesn't have a deep competitive advantage, then you can't even do valuation to begin with. The business needs to have something sustainable, something that is driving customers to come back consistently. They need to have that in order for you to even be confident in cash flows going forward, and no margin of safety can actually protect you from that. Think of it this way. If Foot Locker was selling their own branded shoes, their own Foot Locker shoes, and it was those shoes that were as popular as Nike shoes are now, and they didn't rely on these other brands to sell them shoes that people desire, then we would be much more confident in their existing stores continuing to generate revenue and maybe grow revenue over time. And we would also be extremely confident that when they opened new stores, increased their store network, that those new stores would also be successful. But it's not just that Foot Locker relies on other brands for the products that they have in their stores. There are still significant real estate advantages that come from, particularly in the footwear industry, where a lot of people are still wanting to go into the shop and try on the shoes before they buy them. There's a significant advantage there. The problem is the combination of not having their own privately labeled brands that are successful, as well as being almost entirely reliant on one brand and entirely reliant on a handful of brands. I think it was 5 brands that represent 90% of their total sales. So all the way back in 2019, when I was first looking at the company and I was trying to figure out whether it would be a good investment, I decided I would not invest in the business. I would not even try valuation to figure out what it is worth, because it didn't have a distinct competitive advantage, meaning I couldn't be confident that the business would be thriving over the long term. So when the stock collapsed from about $60 or $70 per share all the way down to I think $15 or $20 per share during the pandemic, and it's back there now, but it fell back during the pandemic, I wasn't interested in buying the stock, even though it was significantly cheaper. and you could make fairly conservative growth projections for the business and get to a reasonable valuation, I still wasn't interested because the business didn't have a distinct competitive advantage. So it wasn't necessary for me to predict this change in how brands would sell to customers from going from physical retailers to online. I didn't need to know that the business was highly exposed to Nike, and that made it risky whether it was going to be that change or whether it was going to be something else like Nike's brand losing popularity and that heavily impacting Foot Locker's business. But I hope you guys enjoyed today's video. As I said, hit subscribe if you got some value out of this and you want to see more content coming up in the future. But with that said, hope you guys have a great day. I'll see you in the next one.